Next, we have trade-ins. Trade-ins, as what you all know, I'm sure you have heard of this, is when you offer a certain product in exchange for a new product. Of course, that would mean that a certain portion of the purchase price will be eliminated. Okay. So that is a trade-in. Now, in order to entice customers, sellers sometimes accept merchandises. Sellers sometimes accept merchandises as trade-ins. So trade-ins are non-cash consideration. Normally, they are tangible assets. Tangible or non-cash property, PPE, could be supplies. And they are also recorded at fair value. So the same rule applies to it. If it's the fair value is not directly given, then you can have estimated resale price minus normal profit margin minus reconditioning cost. So for example, now over allowance and under allowance. What is this? Okay, as what we have mentioned, if there's a trade-in, a certain portion of the purchase price is being eliminated. So for example, you have 1,000 purchase price and then a merchandise is being traded in, so the customer is made liable only to pay, let's just say, 900. So the 100 reduction is treated as a trade-in value. Okay, the reduction because of the traded in merchandise. Now, there are times the trade-in value is higher or lower than the actual fair value of the traded merchandise. Now, if the trade-in value is greater than the fair value, there is over allowance, meaning you're effectively reducing the selling price of your product, because an item which is a fair value of 5,000, so supposedly the amount that should have been deducted from the purchase price is 5,000, but you gave 6,000 amount for it. So it's as if you allowed a reduction of 6,000 from the purchase price. So there's over allowance. There's also under allowance, meaning the trade-in value is lesser than the fair value. So for example, you have the fair value of the traded merchandise at 5,000, and then what you reduce the purchase price is merely, let's just say, 3,000. Okay, so the trading value is 3,000, the fair value is 5,000. Then you have an under allowance. So let's have this for example.
Now in number 3 we have post meridian company. So in that AM PM in the time, PM actually stands for post meridian, AM is anti-meridian if I'm not mistaken. So prepare the journal entry to record the sale. So here the customer handed its old merchandise as a trade-in. The trade-in value given was 4,000. The fair value was 3,000. So as what we have discussed, if the trade-in value is greater than the fair value, then you have an over allowance. If it's the other way around, the trade-in value is less than the fair value, then you have under allowance. In this case, it's greater. So we have an over allowance of 1,000. Now, since letter A asks for the journal entry, we will start first with the journal entry. So first we debit the traded in merchandise. We have inventory traded in, again at fair value, which is 3,000. If the amount is not given, you can compute it using the estimated selling price minus normal profit margin minus reconditioning cost. And then you have the over allowance. Take note, if over allowance, debit. If under allowance, that's a credit. The over allowance of 1,000 We have installment accounts receivable. So originally the price was 16,000, but since the post-meridian company accepted a merchandise with a trade-in value of 4,000, so what is collectible is now only 12,000. And then finally credit installment sales, 16,000. So this is your journal entry. That would be the answer for letter A. Now for letter B, compute for the realized gross profit. So we need to compute for the collection and multiply it with the gross profit rate. So question, what is the gross profit rate? So normally we compute it using sales or installment sales minus cost of goods sold, gross profit, and then later we divide gross profit by installment sales. However, if there's a trade-in, okay, if there's a trade-in, you need to identify if you have an over allowance or under allowance. So if the trade-in value is equal to the fair value, then there's no problem. We just proceed with this procedure or method. However, if there's over allowance or under allowance, it will affect the gross profit rate computation. If there is an over allowance, that means you actually reduces your installment sales. Okay, instead of collecting a higher amount, you gave the customer a higher trade-in higher than the fair value of the traded-in merchandise, which as a result reduces your sales price. So you have the sales price at 16,000. The cost of the over allowance of 1,000. Your adjusted sales is now only 15,000. 15,000 less cost of goods sold of 10,000, you get gross profit of 5,000. 5,000 divided by the adjusted sales. Take note, if there's an over allowance or under allowance, you use the adjusted sales in order to compute for the gross profit rate. That would be 1/3, 33.33%. If it was an under allowance, then that will be plus. Since this is over allowance, that's minus. So you have a gross profit rate of 33.33%. Now, however, remember that in the journal entry, even if you have an adjusted allowance of 15,000, the installment sales you will still record in your journal entry remains at 16,000 minus the trade-in value, minus the trade-in value of the traded merchandise. Okay. So we now have our gross profit rate at 33.33%. We now compute for the collections. Remember, that's collections times gross profit rate. You get the realized gross profit. So, how much is the collection? Now, as for the collection, the problem states that PM company subsequently collects 6,000. So, unquestionably, we have 6,000 collection. However, remember that down payments are also treated as collections. In this case, there is a down payment but non-monetary. So even if it is non-monetary, that is still treated as a collection. So in computing for the realized gross profit, you need to add the fair value aside from cash collection. You need to add the fair value of the traded in merchandise or the traded merchandise. So the fair value of the traded merchandise given was 3,000. So all in all, the collection is 9,000. So that's 9,000 multiplied by 33.33%. You you get rounded off 3,000. Actually, this is more accurate. You get the realized gross profit of 3,000. So always remember, in computing for the total collection, 9,000, aside from the cash collection, you need to add the fair value of the traded merchandise, and then you multiply it with the gross profit rate in order to get the realized gross profit.
Now we have cost recovery method. We will not really dwell on cost recovery method and gross profit method. So the concept of cost recovery method is this. So under cost recovery method, each collection is applied to the cost, and you will only recognize gross profit after the cost have been recovered. If you're going to compare it with installment sales, under installment sales, for every collection, you recognize a portion of a gross profit. That's why collection times the GP rate. Okay. However, under cost recovery method, it's very conservative. You do not recognize any gross profit at all until the full amount of cost is recovered. So, for example, at month 0, there's no payment yet, but you have a cost of 300. At month 1, there's collection of 100. It's applied to the cost, so the remaining cost is 200. But again, there's no realized gross profit yet because the cost of goods sold has not been recovered in full. At month 2, another 100, so the remaining cost to be recovered is 100. At month 3, you have now fully recovered the cost. But of course, there's no excess RGP yet because if you're going to add the collection, 300 is just equal to the 300 balance of the cost. In month 4, since you have fully recovered the cost, then you can now recognize a realized gross profit. Only then you can recognize the gross profit. So in Bisaya, we call it tingub. Tingub pag recognize sa gross profit.
Now we have Jacob Incorporation. It asks us to complete the above table. Take note, the method used here is cost recovery method. So under cost recovery method, you do not recognize gross profit until the cost is fully recovered. So for number 1, installment sales, same thing, you can use our generic formula. Sales gross profit, we have 74,750. 85% based on sales. That means this is 65%. So if you're going to compute for the installment sales, then 74,750 divided by 0.65. We get 115,000. So you have 115,000. Number 2, cost of installment sales. For year 2011, so you have 92,000, you get 36%, so this is 100%, this is 64%, so cost of installment sales is this times 64%. Get 58,880. That's number 2. Number 3 is the gross profit percentage. Oh, this is much easier. For number 3, 103,000 minus 62,830. For 0170 divided by 103,000, that would give us 39%. Okay, 39%. Now number 4. Okay, number 4 is quite tricky. Take note, this is cost recovery method. So you do not recognize gross profit until until the cost has been fully recovered. So for convenience purposes, let's record the cost for each year. So for 2011, the cost of installment sale was 58. Again, these are cost of installment sales. It's 58,880. 2012 is 62,830. 2013 is 74,750. Okay. For number 4, so during 2011, there was a collection for 2011 sales of 27,200. Okay, during 2011. During 2012, there is a 2011 collection. Okay, so the unrecovered cost of installment sales for this one is 58,880 minus 27,200. We have 31,680. Now during 2012, there was a 2011 collection and a 2012 collection. So for the 2011, there was a collection of 48,300. Okay, 48,300. So as you will notice, the total cost has now been exceeded by the total collection. So 48,300 minus 31,680. So you actually have 16,620 recognized as gross profit for this is year 2012 collection. Okay, 2012 collection pertaining to the 2011 sales. So as of year 2012, you can already recognize a gross profit for 2011 sales. But for 2012, what you have collected was only 36,600. So as of the end of 2012, you still have an unrecovered cost of 26,230. Okay, 26,230. Now, during 2013, there is another collection for 2011 amounting to 12,200. Oh, sorry, not here. Amounting to 12,200. This is 2013 collections, okay? 2012 collection, 2011 collection. So 12,200. Take note again that during 2012 collection, the cost have been fully recovered. And under cost recovery method, we recognize gross profit after the cost have been recovered. So since the costs have been recovered during this year, any collections afterwards are treated as realized gross profit. So this 12,200 goes straight to realized gross profit for the year 2013. If you're going to look at the problem, the total realized gross profit on installment sales was 19,250. Out of that 19,250, 12,200 pertains to 2011 sales. So the unaccounted portion is now only, that's how much, 19,250 minus 12,200, we have 7,050 unaccounted realized gross profit. So where do we get this 7,050? Did it came from 2012? Did it came from 2013? Let's examine. Now for 2013, the total cost of installment sales is 74,750. What was collected during 2013 is only 43,450. That means the total collections were not yet enough in order to cover the cost of installment sales. So it would be impossible for this unaccounted realized gross profit to come from 2013 installment sales, because again the collections during 2013 amounting to 43,450 is not even enough to cover this. That only means that this 7,050 is a realized gross profit from the collection of 2012. The question now is, how much was the collection? Okay? So keep in mind that gross profit or realized gross profit is only recognized after the cost has been fully recovered. After 2012 collection, after 2012 collection, there is still an unrecovered balance. The cost of installment sales 62,880 minus the collection of 36,600. There is still an unrecovered cost of 26,230. If there was a realized gross profit of 7,050, that means that the total collections during 2013 is at least 26,230. So how do we determine the total collection? We add 26,230 plus 7,050. So 26,230 plus 7,050, we get a total collection of 33,280. Let's counter check. The total cost of installment sales for 2012 is 62,830. There was a collection of 36,600 applied to cost. There's a remaining unrecovered cost of 26,230. Now, since there is a collection of 33,280, clearly you have an excess, and that excess goes to realized gross profit. The excess is 7,050, which is your realized gross profit, the unaccounted realized gross profit. So the answer for number 4 is 33,280. So you try working out on yourself. This is actually a very good problem. This trains your brain to think logically and to imagine how did the transactions went through. So for number 5, the realized gross profit on installment sales, okay, clearly 0. Because if you remember, the cost is 58,880. What was collected is only 27,200. So we cannot recognize any gross profit yet. In fact, there is still an unrecovered cost of installment sale. So number 5 is 0. Number 6, 2012, how much is the realized gross profit on installment? So we have determined that you have 31,680 unrecovered cost after the 2011 collection. And then during 2012, you collected 48,300. So your cost, your collection, clearly you have an excess. And that means this excess is now your realized gross profit. So 48,300 minus 31,680, you get 16,620 realized gross profit. Do we have a realized gross profit for 2012? Not yet, because if you will notice, as of 2012, after the collection, you still have an unrecovered balance. So the realized gross profit during 2012 is only, that is the 16,620, which pertains to the 2011 installment sales. And that is the last, that's the last problem, the last question. So you try working this out. There are many ways in answering the problems. I suggest you try doing it by yourself so that you can find some patterns and apply it during the exam.
Gross profit method. Gross profit method is the opposite of the cost recovery method. If under the cost recovery method, it's very conservative that you do not recognize gross profit until the cost has been fully recovered. Under gross profit method, all collections are applied first in the gross profit. after you recognize, you apply the collections to the cost. So it's just the exact opposite. So at month 0, no collections yet. So you have the unrealized balance of the gross profit is 100. So at month 1, the moment you receive 100, of course you apply it as a realized gross profit. The subsequent collections are being made to recover the cost. So as you can see, this is the reason why this is not accepted as a practice, because it violates the principle of conservatism. So that ends installment sales. See you in the next video.